Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about. I might dive a little bit deeper into oil. Oil's got my attention. I've been watching oil, and I don't know, it just looks good. And I want to share that with everyone of why I think it looks good. I'm a oil bull over the big long-term commodity bull market. It's very inflation sensitive. It's the number one commodity. It's used in everything for the most part. And it looks good. It looks good. So we'll take a look at it, and we'll go through what um, X has as well. It's going to be commodity related, wealth building, or financial topics. So let's dive in. Let's see what's going on and people are talking about. If you want to follow me, it's at finding_finance, and if you want to join our community, finding-value.com, we can join. We have a training session coming up Wednesday on stock selection, technical analysis, and stuff around those topics, human psychology, what creates the patterns, etc., etc. Coming on down, we've got basic knowledge. When interpreting geopolitics, the U.S. is not only a net exporter of energy now, but is actually the world's largest producer of crude oil due to the fracking revolution. So U.S. is now the world's largest producer of crude oil. We produce 15% of the total crude oil. And Saudi Arabia is number 13. Same with Russia, both 13%. So we're the big dog at the current moment. Coming down, total U.S. vehicle miles traveled have declined by about 2% post-COVID. Per capita miles have declined about 3%. So that's total miles. You can see we've got a little bit of a decline there. Per capita miles have also come back a little bit. So people are driving a little bit less, although demand is pretty close to each other. 2019 to today. History doesn't repeat itself, but now let's look at this. This is the commodities are overvalued. Commodities are undervalued. You can see that they stayed low for the 60s here. And I do think that we are working our way up, and it may stay low for a couple of years. It is possible, not stating it isn't, but I do think that we're going to see a move to the upside here eventually. The commodity bear market from 1980 to 2000. Let's go over that. 1989, fall of the Soviet Union resulted in a shock of excess material flooding the market. Gold was down 70%, silver down 87%, oil down 72%, and gas and copper down 50 to 70%. And that's that black arrow there. 1980 is this guy here. 1980 to 2000 was down here. So that move lower resulted in that type of movement. People ask me about investing in market conditions. The market conditions could be seen in these. You shouldn't be in these areas if you've got a high ratio of commodities being overvalued. You want to get the heck out of there. Then when it gets to the undervalued state and you see the market conditions for credit expansion coming, then it's game on, baby. It's game on. And here we are again in that same type of scenario as 1969. 1969, 1970, that's where we're at, I think. And I know that based off of where interest rates have gone and stocks and bonds and the performance of stocks and bonds in 2022 had the same performance as 1969. So I think the market conditions are right around 69, 1970. And in the commodity bull market from 98 to 2000, gold surged tenfold. Heck yeah. So here's period from 99 to 2008 bull market. In the third period from 1980 to 2000, commodities did poorly and the stock market surged until the ratio again reached an extreme level of undervaluation in 98, 99. That is the bottom, and that's where I would have been buying. I would have been buying aggressively. Many of this time was centered about the tech sector, which literally exploded upwards as the decade progressed. The NASDAQ advanced an incredible 40% per year. After 20 years of weak prices, no one was expecting a turnaround, and the bull market and resources truly surprised everyone. Gold in particular spent most of the 90s being rejected as a barbarous relic. As central banks rushed to sell their reserves over the next 10 years, gold surged tenfold while the S&P barely regained its old highs. Oil peaked at $40 a barrel in 1990, but by 1998, it had fallen 72% to $11 a barrel. And in 2008, it had peaked around $140 a barrel. I added that last portion. Thank you. But yeah, that's what we've got. We had a massive bull market in commodities during this time frame here, and a lot of commodities went up. Uranium bull market, oil, nat gas, everything. And that same bull market is going to repeat itself here, I think, very soon. And I'll let you know the reasons why with some charts here. Let's keep going over some of this. 69% of Permian firms expect to grow production 5% or less this year. They need WTI crude to be greater than $70 a barrel to make a profit in 2024. That's what a lot of people are saying. Explorers need 70 to make a profit. Every past market crash looks like an opportunity, but every future market crash looks like a risk if you're fully invested. Now, let me jump into some crude oil in the mix of this thing, because I have it pulled up. I love crude oil. Crude oil, I've made a lot of money in it. I saw this bull market occur from about 2003. I saw this occur when I first started working. It was in 03, well, actually, it was 04. It was like right there when I first started working. And I saw this move. And I saw some of the moves in the natural gas companies. I saw the impacts of some of the hurricanes that came through during those years. And I saw some crazy outperformance during that time frame. I'm talking like I was watching Chesapeake and Ultra Petroleum. Those are the two that stand out in my head, and they were just up like every day, 2, 3, 4, 5%. It was just like nonstop, 3%, 3%, 10%, 4%, 5%, down 2%, and then just up. It's like, oh my God. And that was in the middle of the third leg and the blow off top. It was all through here. And I was just in awe. Now, I didn't know what the heck I was looking at. I didn't know what was causing it. I thought it was going to continue forever if you see that type of stuff and you're brand new to the market, because I was only in my early 20s. But I didn't see the beginning of this bull market here. I did not see that portion of it. Or it was this portion here that I didn't see, because I didn't get involved till about 04, somewhere in here. And then I saw this whole move to the back end. And I saw some of those companies go from, they 20, 30, 40, 50 bagged from top to bottom. I probably saw them do like a 10 or 20x very quickly. But this is the fractal. This is the beginning of the bull market. This is the end of the bull market for the commodity bull market. That was the same as that ratio we saw earlier, which is this ratio here. 98 to 2008, that commodity to stock ratio is this to this. It's the same exact ratio. I took this fractal here and I overlaid it on the current fractal. And what makes me so bullish on crude oil, I was just staring at this chart, is you've got your three hump consolidation. I always see that in consolidations. We've broken out of that consolidation and we're sitting on top of the consolidation. That is from a very strong position. Because usually what occurs is you break out of a psychological consolidation. This is a consolidation, and we've broken out of that consolidation here. I took the fractal, I overlaid it on what we've got today. And what I did is I kind of cut this out because it's such a big bottom, and I just overlaid it on what I think is the important section of the chart here. So I'm going to back out. That's what it looks like. You can even see the humps that this created, the peak, the other peak, and then you can see it come down. It's almost exactly identical to where we're at today. The movement here. And then if you look, we come on down, and this is where the end point is. Are we at that end point? I don't know. Maybe we still have one last little dip. Maybe we don't. I don't want to try to predict the future of the short term here. But it does look really good. It looks like we could potentially outperform. So I back out a little bit. And if I back out, I'm just going to hit all here. And then I'm going to have to zoom in because I'm on logarithmic to show you guys what I'm seeing here. So this is on logarithmic. You can see we broke out, we came back. Now the fractal, if I were to overlay it and basically match the peak to the bottom here. So I'm taking this fractal here, overlaying it on top and matching the top to bottom here, just to see like where would that go if we were to match it up with this data that we've got going on. So I went from peak to bottom. I matched up those three little humps, and that projects out to about $300 and something a barrel out in 2030s. And what's interesting is someone had posted this, and this is the gold to U.S. oil chart here, and then they overlaid a sine wave on top of it, and we've got a shoulder, a head, and a shoulder, and we're putting out the right-hand portion of this shoulder where we could come all the way down. And look where it ends up at, 2031. 2031 is exactly where this lines up if I match up all of this the best I can. So we've got the ratio to oil to gold ratio with the sine wave of the historical pattern of the sine wave kind of moving up and down. We've got this fractal that also agrees with that going on, and I'm like, okay, this looks really good. So then what I did is I said, you know what, let's chart some other stuff here. So I was looking at the crude oil ratio just to seeing what the crude oil ratio would look like. So this is crude oil, and let me take it off logarithmic. This is crude oil to silver, and I was like, you know what, let me throw some trend lines on here. This looks kind of interesting here. What we have is kind of like this big consolidation here of crude oil against silver, and I was just playing around with stuff. I'm like, well, we've got a breakout and a return move. It's like, is this going to go and run to the upside here very soon? I kind of dove in and I'm like, well, that actually looks pretty good. We've got a nice big bullish candlestick that occurred last trading session, and this is a big consolidation here, and we've broken out of that consolidation, and maybe we do head higher. Then I was looking at crude oil to the S&P 500. We are at a very low level. This is another 1, 2, 3 consolidation. We've broken to the upside. We usually, when you break, you get a return move. It's very much like the commodity to stock ratio, which is commodity to stock. And then I'm like, okay, let's zoom in on that. And then this is a weekly. This is a pretty good looking chart. It looks like it's trying to bottom and potentially turn in the ratio. And this does look constructive. We're starting to get some nice little green candlesticks, not much selling pressure. It's close to support. It's looking pretty good. We've got crude oil versus gold. Another one where we've got a big uptrend coming from the 80s all the way to about 2008. That was the big uptrend. And then we've got the big pullback. Here's your 1, your 2, and your 3 consolidation with the ratio. And then we've broken out of that consolidation against gold. We've got a return move. And then I'm like, well, okay, let me see if we got, a decent candlestick over there. And it looks pretty decent. It looks like we've got the green army showing up where we could potentially head higher. I'm not saying it will. I'm just saying it potentially could. Things are starting to come together and it looks pretty good. And I don't think we've got a falling wedge necessarily, but okay. Crude oil versus platinum, that's looking pretty good. We're back against a support level back in here where we've touched that level multiple times. We're sitting on top of it. We've come on up. We've got that same type of pattern. I kind of zoomed in. It's like, well, we're getting a little bit of a move higher here. You could say, well, let's throw, a trend line on here. This one's going to fling it way out. But if I throw kind of a rough trend line, it's like, whoa, this is kind of, it is breaking here potentially for crude oil versus platinum. So I'm like, okay, that looks pretty good. Crude oil versus palladium, it's had a monster run here recently from the palladium pullback, but that looks really good too because we've got a falling wedge into a corner, which is broken to the upside against palladium. And, crude oil looks pretty good here. We've got nice big green candlesticks, small little pullbacks, generally good for a move higher. And it's coming from a ridiculously low level down here. compared to history. We've got a long way to run up if we want to run up in this ratio, where crude oil could do some pretty good outperforming. And then we went crude oil versus uranium. And I like uranium, but I mean, look, guys, this is back down to like ludicrous levels for how cheap this is. Um, it is incredibly cheap. And are we going to see this come back up? I don't know, but you can also kind of see a faint. I'm just going to kind of draw it through here, kind of a faint squeezing through here, where that's been consolidating a little bit there, and maybe this is at the bottom. Think of it as 1, 2, 3, and then maybe this is going to rip to the upside. I don't know, but I just thought that was kind of interesting looking at this. And this was the last, say, the bull market through here, and then we can see the consolidation. A lot of the times you get that consolidation there, and we were at the bottom of it, meaning that crude oil is very cheap in relationship to almost all of these different assets. I know a lot of people look at the gold to oil ratio. That might make more sense. We're at 27.8, and we're coming from a ratio that was hitting on the 30 to 1 ratio. So 1 ounce gold could buy 30 barrels of oil if this thing wants to decide to show up. There it is. We were kind of hitting that 1 to 30 ratio, which is very, very cheap. And we're starting to come back down, perhaps. Almost looks like a double top when you look at it from this perspective, when you flip it against gold. So, oil has my interest here. It looks very bullish, and we'll see if it follows through. It's not in the momentum yet, but it could follow through here. I wanted to see if this was going to break or break back down. I'm still waiting for that. Still waiting for confirmation. But yeah, that's looking pretty good. Coming back over here to talk more about what people are sharing. Lance, and this is could be more home builder related. It says, "This is the busiest winter I've had. I was expecting new construction to slow down because of interest rates, so that way I picked up so many new builders in 2022, but it has not slowed down at all." And that's message from a window contractor I know in the Midwest, that Lance says. And builders are continuing to build, and whenever we get these housing starts, if they continue to go up, that's generally good for oil to go up and all these different commodities. I am very interested in the housing market and the real estate market. And if you're a commodity investor, you should be too, because that's what's driving the credit expansion. I was also looking at total bank credit. Total bank credit is another thing that I was looking at. And total bank credit, if you look, it's starting to go back up again. You can also look at the total loans, like bank loans. I should probably type total bank loans. Total bank loans are also, this total bank loans are kind of leveling out from what I can tell here. So I was looking at total loan. Oh, this is loans and leases and bank credit. Hold on. It's total, hold on, bank loans. The pressure is on. Real N, that's what real estate. So this is your real estate loans, all commercial banks. You can still see that it's heading higher. It's not rolling over. It definitely rolled over in 2020, and that's definitely a slowdown. But it's slowing down. The rate of change is slowing down, and it is not rolling over yet. It definitely rolled over in 2008 here, 09. It was 09 when it rolled over. This is a big issue, and this is a good time to buy a house as if it rolls over. But it hasn't rolled over yet when I was looking at all commercial bank loans and total bank credit. So we were still looking good there. It says less than 2% of mortgaged homes have negative equity. So that's really good. We're not going to get any forced selling from what I can tell. It's very low in terms of negative equity. That's very good. Here's a story in 4 charts. Housing supply continues to be underestimated. Bullish net worth and jobs. Affordability is the worst in history, which means we have a shortage. Supply is the lowest in history. Prices set to go higher again in 2024. Housing costs understated in inflation as measured by Fed dramatically. So here's the 4 things. Traditional affordability is the worst in a long time. You can see in the 80s, we were up there as well. We've got, this is housing inventory that is incredibly low. We just total downtrend. Is this starting to break that downtrend? I don't think he's drawn it in properly, but could be. We've got housing supply and prices. So the housing supply, as it goes down, housing price change on the left axis, which is percent, you can see go up as a projection, I think, of history when you get to these really low levels. So as you have a under 6 months of inventory, they project rising prices. And as you come up and go above the 6 months worth of inventory, you can go into negative territory for prices. And that's where, generally speaking, you see the correlation of home price appreciation and inventory levels. Inventory levels, when they get really low, almost always end up with higher home prices. It is a historical anomaly if that occurs where you get under 6 months of inventory here. If you're under 6 months and you have house prices decline, that's an anomaly. Here's another one, house price index versus owner's equivalent rent in residence. You can see there's a big gap that is occurring, but that's also a gap, I think, because of the shortage that we have in the market. Inconvenient for some positions and framework here. So residential construction payrolls made a new high in December and have increased by 14,000 since the July low. This is not a recessionary pattern. We just looked at oil. Oil is sitting on top of its pattern. It looks good to potentially go higher. And again, that's probably an early call until we get to see some stronger data points, some more data points and stronger data points. The ratios all look good too for oil. And generally speaking, if it's not a recessionary pattern and we go into this big housing start kind of new home build boom, that's when oil takes off because you get credit expansion. And that's why I'm looking at, these real estate loans are continuing to go up. Now, if they lower interest rates, I think this is going to push it higher. Much like 2002, 2003. We may have gone through the slowdown. It's hard to say. We might have. I don't know. Here's another one. Logan says, I was going to let this go at 12 years, but someone keeps telling me that it will be worse than 2008 in 2022, in 2023, and in 2024. So year 13 is on. And in 2024, we had shadow inventory that everyone was talking about. 13, higher mortgage rates are going to slow this thing down. QE ending in October. That's what's going to cause the housing market to crash. Manufacturing recession in 15. 16, home prices got back to the bubble high. 2017, no good reason. 2018, 5% mortgage rates, start of the bubble crash for sure. 2019, home price growth was cooling off. 2020 was COVID. We're definitely going to get a crash because of COVID. 2021 was mortgage forbearance. 2022, 7% mortgage rates. It's definitely going to crash. 2023, historically low housing demand. Those are all the reasons that everybody thinks that we're going to get this big crash. 2024, we'll see what the reasoning is that they've got for the crash. People just can't afford it. Affordability. But if you don't have supply, typically the homes go up. We've long felt that the only value of stock forecasters is to make fortune tellers look good. And I know a lot of people are asking, well, what about, Harry Dent and his call on the melt up and then a crash? And what about Henrik Zberg? And what about all these guys that are calling for crashes? I don't know, guys. I mean, it's very rare to see these large crashes unless the housing market gives way. And I just don't see it. I don't see it by all the data that I just went through there. The housing market looks like there's no supply. That's what it looks like. Here's another chart. This is bullish uranium versus SPX. Beautiful breakout. Now a small flag pattern before moving up. God, guys, look at this chart. Uranium looks fantastic here. I mean, look at that breakout and the small little pullback, little flag pattern there. Looks fantastic. Just hold on. Don't let people scare you out of this thing. And there's the housing price crash, people, over 12 years. As inventories go to nothing. Good luck, guys. And that's where I'm going to stop it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like. And we do have a training session Wednesday, 8:30 a.m. I'm going to cover human psychology, technical analysis. How do I select stocks? What do I do? How do I look at things? Maybe we'll dive into some of the things I look at in the financial balance sheets and stuff. The balance sheets generally don't determine if I go in it or not. It will be the change in balance sheets that I'm looking for. So that's what I've got for today, guys. Hopefully you're having a good day, and we'll catch you later. This is Finding Value.